One of Tesla's biggest and most bullish investors ever is Ron Barron, who is the founder and CEO of Barron Capital, which is an investment firm with around $45 billion of assets under management. And two of the largest holdings of that firm are actually Tesla and SpaceX. So when Ron comes out and has something to say about Tesla's current state or their performance or their future potential, investors usually listen to him. And I'm one of those investors myself. I actually really like Ron. I appreciate his usually positive and more kind of optimistic view on stocks, especially these days when there's so much fear in the market and the economy. It's a little refreshing to actually get a more upbeat view on everything going on. Well, most recently, Ron held his 30th annual Barron Investment Conference where he was interviewed by CNBC, and man, he laid out some very solid, very bullish arguments for Tesla during that interview, and he even hinted at the $25,000 Tesla Model 2 coming within the next year, which is pretty crazy to think about. So it was all very interesting, all the things he talked about in the interview. I can't wait to run through these with you. Now, the way we'll do this, because of copyright, I can't just show the entire interview, but I'll summarize Ron's biggest arguments and points that he made, and then I'll give my own reaction to each one of them as we run through the list. So let's go ahead and just jump straight into it. All right, so first up here, the interviewer brought up a report from HSBC who gave a really low price target on Tesla stock and valued it as mostly just an automobile company, to which Ron responded by saying that he instead views Tesla as a technology company that provides services to not just their own company, but also other companies that can't possibly match them because of their superior data, technology, and how they're making vehicles cheaper than ever before. And yeah, that's something that I strongly agree with myself. Tesla is not only an EV company, but they're also one of the largest autonomous driving platforms in the world, which Musk has already said in the past too, that he'd be more than happy to license that technology out to other companies as well, which could be huge considering that UBS analysts project the robotaxi market alone to be worth trillions of dollars by 2030. But on top of that, they also have the Semi for a logistics market that is worth trillions of dollars, which has already been ordered by many other giant corporations like PepsiCo, Walmart, FedEx, and more, with most recently PepsiCo praising the Semi for its amazing performance. And who can forget about their giant energy business, where I think battery storage will be one of the most important and crucial parts of the trillions of dollars renewable energy market, where Tesla has already grown their Powerwall installations from 100,000 in 2020 to 200,000 in 2021 to more than double that this year, already surpassing over 500,000. And commercial use will probably be even bigger as they deploy massively large solar generation and storage systems, where they will also sell add-on services like tracking and managing to those other companies and entities as well. Not to mention the more obscure Tesla robots, which many people are kind of laughing at right now, but in the future, robotics could also be a market that is worth trillions of dollars as well, and not just from consumer use, but also for commercial factories that can help drive down costs, which we know that Tesla themselves will be using the bots for that very same reason too. So I fully agree with Ron's point there. I think it's why so many of us have chosen to invest in Tesla. It's for that innovation, that lack of fear, for really pushing the boundaries and trying new things and disruptive things, even if you get ridiculed for it or kind of mocked for it in the short term, but longer term, it may all be worth it. Moving on though to the next point, he gave an example of how Tesla has so much better profitability than other automakers, saying that every time Ford makes an EV, they actually lose $36,000, whereas Tesla makes a profit of around $8,000 per car, which is also down right now from a high of around $15,000 before the economy started tanking and inflation and interest rates started hurting their margins. He also noted though that every time Tesla builds a manufacturing plant for $7 billion, it can generate $15 billion per million cars per year, whereas an ordinary car company would only make around 15 to 20% on capital invested this way, but Tesla was generating around double their investment per year and is still doing at least their initial investment today, even with the weaker economy. So basically saying that Tesla can generate 100% return on investment while rivals are only making around 20% at most. And he finished the point by saying that Elon Musk made Tesla the lowest cost business in the space, and everything that they're doing right now will only drive down costs even further. And yeah, I agree with a lot of this here too. I can't really speak to the specific numbers that he used there, but Tesla's superior profitability has definitely been a major reason for people investing in the stock today, as Tesla really went all in on electrification and autonomous technologies from the start. Whereas legacy players really took their time, they were kind of lazy about it, and now they're having to deal with the consequences of that, having to transform their factories over into building EVs, which are lower margin for them, while also cannibalizing the sale of their higher margin ICE vehicles too. And as a result, Tesla usually does around double the profit margins of the auto industry while still putting up much more revenue growth too. And more recently, they've been investing in new platforms and factory innovations that should drive down costs even further, which has not only become a standard across almost every quarter at this point, which you can see on this chart here, but for example, during this year's investor presentation, Tesla showcased various new production techniques that both lower costs while also reducing the manufacturing footprint and improving operator density and space-time efficiency by 44% and 30% respectively. And remember that Tesla bot that we talked about earlier? Well, they've already said that they plan to deploy thousands of them to their factories to reduce costs even further. And of course, these robots can work 24/7 without needing breaks, so production might actually increase there as well. I mean, in the presentation, they even showed the robots building other robots too, which is admittedly kind of creepy, but I'm sure it'll be beneficial to the company. And it's not just robots, but also battery technology, where Tesla seems to be way ahead of the curve, as they've already reduced the size of their new 4680 battery production footprint by nearly 10 times the size, which allows them to scale up battery production much faster and more efficiently than the competition. They also reduced the cost of building a Model 3 by a massive 30%, and they're now aiming to reduce those costs even further for the upcoming next generation vehicles by as much as 50%, which Ron also comments on a little later, so let's get back to those points. Well, next up, he said that in the early 1900s, automobile companies were tremendous innovators, but it is no longer the case, as in the 1950s, they shifted their focus over to profitability by outsourcing all of their supply chain. However, it was ultimately to their own detriment, as most of these companies went fully bankrupt by the hundreds. However, Tesla, on the other hand, has been innovative from the start, which as of right now, their millions of electric vehicles with autonomous functionality are driving on average around 30 to 40 miles per day, which is translating to over 100 million miles of data being collected every single day too, which he noted that Tesla will also have more compute power than anyone else to train all of that data as well. And here again, I have to agree with Ron. I mean, in fact, during their last earnings report, Tesla released this chart showing all of the full self-driving beta miles. And mind you, this doesn't include just any raw miles driven. It will be way larger. This is only for the FSD beta. And you can see how over the past year, it's just been growing exponentially by a staggering amount. So I can only imagine how much larger and rapidly this thing will grow as more and more Teslas hit the road with that, full self-driving technology, and especially when they launch the robotaxi service. But Ron also mentioned compute power, and yeah, we know that Tesla's new Dojo supercomputer for processing all of this data was just unveiled last year, and it was so powerful that it actually tripped the city's power grid in Palo Alto before the city had to call them to see what the heck was going on. And yet this most recent quarter, they actually managed to more than double that compute capacity, which is pretty crazy to think about. But going back to Ron here, the interviewer then asked him about all of the other automakers putting out huge goals for EV sales, but then always seeming to scale back later, saying that there just isn't enough customer demand for them. So, does he think that it's because of the products that these other automakers are putting out, or is there really just not as much demand for EVs than we previously thought? To which Ron responded saying that there are 1.5 billion ICE vehicles that need to be replaced, and currently there are around 80 million new cars being sold every year, but only a small percent of those are actually electric at around 10%. However, eventually he thinks that pretty much all vehicles will be electric. But as of right now, the EVs that are being put out by other automakers are either very expensive or just not attractive enough to sell. And on top of that, he says that the poor sales are also a result of both the automakers and even the dealerships not really wanting to sell EVs in the first place, as automakers are still losing money because of the low profitability combined with the cannibalization of their own ICE vehicles, while the dealerships don't want to sell the EVs either because they are such low maintenance, which is where the dealers make the most of their money. But on EVs, there's almost nothing to service or repair, so they end up losing money on that too. And yeah, I don't really have much to add to this point here, as I just kind of flat out agree with it. It's actually something that I've been saying for a long time myself too, is that a lot of these legacy players will have to play catch up now, which will present them with a lot of speed bumps along the way that Tesla doesn't really have to deal with because of that first mover's advantage, going all in on the technologies from the start, and they've been kind of benefiting from that ever since. And so in the meantime, what I think you'll see is a lot of these legacy players just being in a bit of a transitional phase with their business right now. A few years here of low profitability, low growth, kind of the polar opposite of what I think you'll see with Tesla going forward. But that isn't to say that they're all going to go under or that none of them can become rivals to Tesla in the EV market. I actually think it's going to be a large enough market to support multiple players. And I actually bought a little bit of GM stock myself. It's only a tiny position, but I like what GM is doing. I like the upcoming EVs that they have down the pipeline. And I like that they invested a bit heavier into autonomous technologies than some of the other legacy players. And I just felt that the stock was pretty attractive at the very low valuation after it crashed by so much. So I bought a little bit of it. I still think that Tesla is going to be the better play on the future of the auto industry as a whole. But I still think that the market is going to be large enough for a couple of these different players to coexist too. So I kind of like it as well. Anyway, moving on to the next point, they talked about a bunch of union stuff that I don't really want to go deep into in this video for the sake of time. So we'll just move past that over to the part where the interviewer asked about China, specifically what he thinks about the competition gaining ground there and stealing market share, while the Chinese economy is also weakening and could potentially hurt Tesla's growth plans. To which Ron responded that Tesla right now is doing around 1.8 million cars in total, with the goal of hitting 20 million by 2030, and China accounts for around half of that production, but a large portion of it gets exported out to Europe, which they'll have to rely on less and less over time as they build more factories in Europe and save on shipping and transportation costs. He then elaborated a little bit more on China though, and he's basically said that it's more of a kind of unique catalyst, kind of like a bonus that isn't really meant to be considered the main growth driver for Tesla, saying that China simply invited Elon Musk and Tesla to come into the country without needing a Chinese partner to sell through, which he said is the only outside company to receive that privilege. And it was because China's automotive industry was failing and they needed something like Tesla to help it recover. Not to take control of the entire market, but just for it to be a mutually beneficial partnership where Tesla gains access to the gigantic Chinese market while China also gains expertise in auto manufacturing and innovation so that their own companies can grow and innovate better too. He then noted that the success that they're already having in China is very strong, and it's also in large part thanks to the Chinese executive that they have over there who's been in charge of the Chinese operations, and that he's been doing a great job so far and will likely become a future leader of Tesla in some way too, saying that he's also been put in charge of Texas to make sure that the new factory in Austin gets ramped up smoothly, and that he will likely end up running all of Tesla's automobile business in the future. And then finally, Ron added that that he thinks Tesla's relationship with China is exceptionally good right now, that both parties are benefiting and that business will continue to grow there, but that Tesla will also keep expanding everywhere else around the world, building more factories for low-cost cars. To which he then finished it all by saying, "Wait till you see what's going to happen when all of a sudden they start selling cars instead of for $40,000 a piece, they start selling them for $25,000 a piece, which is going to happen in about a year or a year and a half for the new model, which they think is going to do 5 million cars a year for the Model 2. That's coming." And yeah, once again, I gotta say that I fully agree with Ron here. Not only has Tesla been expanding their factories for years now, which Musk also said during their investor meeting last year that they'll aim to build around 10 more factory plants, gigafactories, in order to reach their goal of producing 20 million cars by 2030, which is the all-important metric, by the way, that Ron Barron himself has frequently cited for Tesla stock reaching $1,500 a share, which, by the way, would be more than 6 times the current price. But all the meanwhile, they're also expanding their already existing plants and upgrading them to reduce costs and get ready for the upcoming next generation platform of vehicles too, which is probably referring to that $25,000 car, as during the presentation, they mentioned that it would cut the price of their vehicles in half from the Model 3 and Model Y, which would be just about perfect pricing for the release of that cheaper $25,000 car, the Model 2. And it's not just Ron that thinks it's coming soon, but even several other analysts have been predicting the same thing, including the well-known Tesla analyst at Loop Ventures, who predicts a 2024 unveiling as well, which also lines up with Elon Musk himself saying that he thinks the robotaxi service will come out just around that time too. Personally, I think the cheaper mass market car will probably get revealed in 2024, but not actually released until 2025 or later, along with a robotaxi service. Just knowing how Tesla is, they like to reveal products or services very early on when they know that they still have a lot more work to do on them in the future. But this time frame also lines up pretty well with the New Mexico plant that will be using the next gen platform, and I think by then they can expand into other areas too. So it really all lines up pretty well for, I would say, really a time frame of like 2025 to 2030 just being really big, really important years for Tesla in terms of new products, new services, more expansion, production ramp, and of course growth. I think you're going to see all of that in the coming years. But anyway, that's going to just about do it for today's video. What do you all think? Do you agree with anything that Ron said or that I said myself? And how do you feel about Tesla? What's your assessment? I'd love to hear your thoughts down below. We can have a chat down there. But thanks again for stopping by, my friends. Thank you for all your support. I hope you're all doing well. And I will catch you in the next video. All right, take care, everybody. Bye-bye.